The financial world is currently locked in a quiet civil war. On one side, you have the income crusaders, who believe a stock that doesn't pay you is just a speculative gamble. On the other, the total return purists argue that dividends are an accounting trick that actually slows down your wealth. Both sides are looking at the same numbers, but they're seeing two completely different realities. To understand who's actually winning, we have to look past the ticker symbols and look at the invisible mechanics of how wealth is actually generated over a human lifetime. If we look at the broad market history starting nearly a century ago, in 1926, the data tells a story most people ignore. In the short term, dividends seem like a minor bonus, contributing about a quarter of what you earn. But if you zoom out to a 20-year horizon, those small payments evolve. They eventually account for over 57% of your total wealth. Think about that for a moment. More than half of your future net worth could come not from the price of the stocks going up, but from the cash they spit out while you're sleeping. But here's the kicker. In certain jurisdictions, a couple could theoretically bring in nearly six figures in specific dividend income and owe the government exactly zero in taxes. It sounds like a loophole, but it's actually a fundamental part of the global financial architecture. Whether you're holding a legacy beverage company, a high-tech fund, or an advanced derivative strategy, you're participating in a system designed to move capital. Let's break down the first mechanism, the corporate maturity wall. Why does a company like a global snack giant or a massive pharmaceutical firm give you money instead of keeping it? It's not because they're being generous. It's because they've hit a wall where they can't find enough new, profitable projects to swallow their billions in cash. When a company is young, it's hungry. It needs every cent to build factories or code software. But once they own the shelf space in every grocery store on Earth, they have a problem of excess cash. That's when they start sharing the spoils. Now, critics love to point out a mathematical reality. If a company is worth 100 per share and pays a 2-unit dividend, the company is now technically worth 98. They say it's a wash, like taking $5 out of your left pocket and putting it into your right. But this left pocket, right pocket theory ignores the total return engine. When you take that 2-unit dividend and immediately use it to buy more shares, you're not just moving money, you're increasing your ownership stake. Think about a global beverage leader over the last 5 years. The price alone grew by about 50%. That's a decent win. But the investors who hit the reinvest button saw a return closer to 76%. They ended up with the same result as a high-growth tech company like a leading electric vehicle maker, but with one massive difference. The ride was significantly smoother. While the tech stock was swinging wildly like a pendulum, the dividend payer acted like a stabilizing anchor. Is your nervous system calibrated to handle a 30% drop in a single month? Or would you prefer a portfolio that pays you to wait for the market to recover? This leads us to the historical shift we've seen in the last few decades. If you look at the 1940s through the late 20th century, dividends were the primary engine of the market, often providing a huge chunk of the total returns. But if you look at your screen today, you'll notice something strange. In the 1980s, you could easily find the broad market yielding 4 or 5%. Today, you're lucky to see 1.5%. Why did the well dry up? It's the result of 3 massive tectonic shifts in the global economy. First, we entered the age of innovation. Companies like the ones building your phone or your AI assistants would rather spend billions on a new data center than send a check to a shareholder. They are betting that their innovation will grow the stock price faster than any dividend ever could. Second, the buyback revolution changed the game. Instead of sending you cash, which might be taxed immediately, companies are buying back their own shares. This makes the remaining shares more scarce and drives the price up. It's a more tax-efficient way to return value, but it robs the investor of that consistent cash flow. Third, prices have simply outpaced earnings. Because everyone is so desperate for growth, they've bid up stock prices to the point where the yield, the dividend divided by the price, looks tiny. This brings us to a very dangerous psychological trap. When yields are low everywhere, investors get desperate. They start yield chasing. They see a stock yielding 8%, 10%, or even 12% and think they've found a golden goose. But in the markets, a high yield is often a distress signal, not a gift. Before we see how the system can use your own greed against you, if this analysis is opening your eyes to the hidden gears of the market, subscribe and leave a like. It helps us keep the analysis coming. Let's continue. Have you ever wondered why a company would offer a 10% yield when the rest of the market offers 2%? It's usually because the market knows something you don't. Remember, yield goes up when the stock price crashes. Take a look at the history of a once mighty industrial conglomerate or a massive pharmacy chain. For decades, they were the kings of dividends. But when their business models started to rot from the inside, their stock prices plummeted. To the untrained eye, the yield looked like it was skyrocketing. But that yield was a siren song. Eventually, the cash ran out, the dividends were slashed, and the investors were left with a broken stock and no income. It's like a restaurant that's failing and starts offering 90% off coupons just to get people through the door. It's not a bargain, it's a final gasp. So how do you spot these yield traps before they snap shut on your capital? You need a three-step mechanical check. First, look for the yield spike. If a stock's yield is suddenly double its historical average, the market is betting the dividend will be cut. Second, check the payout ratio. If a company earns $1 and pays out 90 cents in dividends, they have no room for error. A healthy company should usually keep at least 40 to 60 cents of every dollar to reinvest or save for a rainy day. Third, look at the debt load. If a company is borrowing money just to pay its dividend, you're looking at a financial house of cards. This happened to a major telecommunications giant recently. They spent years trying to maintain a king status while their debt ballooned, until they finally had to cut the payout in half. Because individual stocks are risky, a new wave of modern income funds has taken over. These are the ETFs that use complex covered call strategies to manufacture high yields, sometimes hitting 10 to 12% annually. These funds don't just rely on the companies paying them, they rent out their stocks to speculators. They sell the upside of their holdings in exchange for immediate cash. In a flat or choppy market, this is a brilliant way to generate income. However, there is a ghost in this machine called NAV erosion. If the fund sells away all its growth to pay you a high yield today, the actual value of your investment might slowly shrink over time. You're getting a fat check every month, but the principal is dissolving. Is it worth giving up 20% or 30% of your future growth just to have cash in your pocket today? For a retiree who needs to pay for groceries, the answer might be yes. For a 25-year-old with 40 years of work ahead of them, the answer is almost certainly no. Now let's talk about the tax ghost. Many people avoid dividends because they think the government takes too big a cut. But if you understand qualified dividends, you realize the tax code actually favors the investor over the worker. In many countries, if you hold a stock for a certain period, the dividends are taxed at a much lower rate than your salary. If you manage your expenses and stay within certain income brackets, you can effectively live a high middle-class lifestyle while paying a lower tax rate than a person working a minimum wage job. But be careful, not all income is created equal. Modern income funds often pay out ordinary income or return of capital. One is taxed heavily, the other isn't taxed at all today but lowers your cost basis, meaning you'll pay more when you eventually sell. If you have access to tax-advantaged retirement funds like a tax-free savings account or a pension scheme, that is where these high-income strategies belong. Inside those wrappers, the distinction between qualified and non-qualified income disappears. It all becomes tax-free. This brings us to the seasons of investing. Your strategy should evolve as you age. In your 20s, you are in the planting season. You need growth. Chasing dividends now is like eating your seeds instead of planting them. In your 40s, you move into the stabilization season. This is where dividend growth funds act as a shock absorber. When the market drops 20%, seeing those dividend checks hit your account provides the psychological armor you need to keep from panic selling. Finally, in your 60s, you reach the harvest season. This is where the psychology of dividends becomes your greatest asset. There is a well-documented psychological phenomenon where retirees are terrified to sell their shares. Even if the math says selling 4% of your portfolio is the same as receiving a 4% dividend, it feels different. Selling shares feels like you're killing your golden goose. Receiving a dividend feels like the goose just laid an egg. If that feeling prevents you from selling at the bottom of a market crash, then a dividend strategy is worth its weight in gold, even if the total return is slightly lower. At the end of the day, the most successful investors aren't dividend investors or growth investors. They are financial architects. They realize that dividends are just one tool in a very large toolbox. The real secret isn't finding one magic stock. It's building a cash flow ladder that combines interest, dividends, and the strategic sale of assets. This creates a resilient system that can survive any economic weather. Don't get caught up in the internet arguments. Math is important, but your ability to stick to a plan is more important. If you're worried about your portfolio disappearing, look into strategies that protect your net asset value from eroding over time. So after looking at the mechanics, what's your primary goal? Are you building a growth engine for the future, or are you looking to create an income stream for today? Let's talk about which strategy fits your personality best in the comments below.